Good morning, everybody. Welcome back to Schwab Coaching for the Thursday edition of Trader Talk in today's market. I'm your host, Kevin Horner, joining you from a beautiful and chilly Denver, Colorado. Today, I'm running solo with you all. That is the plan for our Thursday segments with you. But I am pleased to be joined by my friend, fellow coach, Barb Armstrong here in the chat. Great coach, of course, an excellent educator, somebody that's got started on the viewer side of things here with the YouTube Schwab Coaching channel and became a coach of her own out there to educate all of you as well. So say hi to Barb for me this morning, everybody. She'll keep an eye on things in the chat. Of course, I'm going to do the same with all of you. On these solos, I do love hearing from you all. When we're working through the discussion, your questions, your comments certainly help to drive the content of the segment. So feel free to post in there for the duration, everybody. Lots and lots of familiar names in there this morning. All right, so before I get started, please take a minute, follow Barb and me on X, Kevin Horner, CS, and Barb Armstrong, CS. It's a good way to get with us when we are not hosting shows. I've been trying to kick up my activity there for you all, highlighting a number of charts and then also revisiting those same charts after we've seen some new price action, some new moves, and just continuing the conversation. So if you're ever wondering about that process, what are traders maybe thinking about? That's the kind of thing that you might get, from following me on X. And if you're following Barb, you're going to get a lot of the same stuff, but you're also going to get some wonderful motivational posts, some great reminders of ways to stay level-headed and approach the market with a plan. So hopefully you're taking advantage of those opportunities, everybody. Now, let's cover some disclosure detail, and then we'll get right into the discussion. Remember that everything we cover here is informational and educational only, meaning simply we do not make recommendations nor endorsements for a particular strategy in trading the market here. We do talk a lot about technical analysis, though. We talk concepts and strategies that traders may choose to utilize in the market as they're trading. But bear in mind that technical analysis is just one piece of the puzzle in evaluating the market. We do not encourage you to make decisions exclusively off technical analysis. Our agenda, as always, is that top-down methodology, everybody. We'll start broadly. We're going to hit up the major indices as we usually do. We'll touch on some industry groups. I'm going to try and get to charts of all of the 11 domestic sectors there for us today, just to kind of level set, if you will. And then maybe a number of key equities today. We had a few reporting after the market yesterday, some big winners, some big losers. We're going to look at as many charts today as we possibly can. So that is the agenda. Let's get to business. So first, we're going to start as we always do with that S&P. Everybody, we're doing the same thing, right? We are waiting on that breakout. For those of you that watch, we've been talking about it now for about 3+ weeks, right? We had this excellent bounce back off of that January 13 week open and pushed all the way back to make a new short-term high, but it really wasn't. It is a new high by definition, right? We know that prices traded up there, but at the same time, we've not really broken out. So we've got this channel of slightly lower lows, slightly lower highs, and having not broken it, we really don't have a new directional move for you short-term traders just yet. So what are we waiting on? We've been talking about it. We would love, if you're bullish, you'd love to get outside of that downtrend line, right? We want to see things moving to the upside. In fact, what we would like to see is an initial move that gets us through, kind of like this, and then we get that little hiccup back and fill, and then we just keep doing this number, right? Just keep moving on up. That's what we want to see. And we haven't done it yet. And the truth is, we don't know if we can, of course, but in order to make any of this stuff right here that I just drew in, we got to get above that downtrend line. So if you're bullish and wanting to be bullish, waiting to deploy new funds, it is likely going to be in this zone on a breakthrough to the upside. That's an initial first opportunity for bullish traders to deploy new money. Now, that is probably working against some closing valuations. Remember, you'd like to see, generally speaking, traders want to see closing values that validate their breakouts. It's one thing to trade through a resistance level intraday. It's a whole other thing to trade through it at the close of business that day. And further, it's important to remember that some of you do want confirmation. You might say, hey, I got a day closing over that downtrend line, but only one day. And some of you want a second day or a third day of confirmation, the so-called Horner rule that we might utilize here. Essentially, it just states giving yourself some semblance of confirmation, knowing what it is that's going to encourage you to take action, right? Whether that be that first initial trade, buying some because you broke the trend line, or buying more because you made a new high. Having that plan and then kind of adhering to things is ultimately the kind of steps that a trader can benefit from. That consistency of planning and process is really paramount to your longer term success. When I say longer term, I'm just talking about trying to be consistent enough that the trades you make over 2, 3, 5 years are bringing you the returns that you're looking for, right? Ultimately, that's what we're striving for. If we're not making money in trading, then maybe we have some other decisions to be making. All right, so S&P dabbling with a breakout. We had a slightly elevated PPI number today, came in a little bit higher than expectations. We got it in reflected at a 0.4% increase for January, higher than the consensus estimate of 0.3%. Excluding food and energy, the core PPI was up 0.3% for the month, which was in line with forecasts. But the truth is the market digested yesterday's hotter PPI pretty well. We opened weakly, finished strongly. So we can continue to take some solace, everybody, perhaps in the belief that the action starting weak, finishing strong, as an example, that is more bullish in nature, of course, and traders do prefer to see that. You don't like the idea of starting strongly and finishing weakly on an intraday basis. So the fact that we're managing our concerns about CPI and PPI effectively and rallying after week opens, we can still take that to be a positive development, even if we're not breaking to new highs. Now, we would love to break to new highs. We're going to feel a lot more confident if we did. But for now, a little bit of a wait and see. Okay, NASDAQ 100 might actually be in the midst of getting outside of that trend line, right? If you can't see it, I'm going to draw it in. We've got a little bit of an ascending, well, actually more like a symmetrical triangle, I suppose. Drawing the lows through here, catch that bottom we made yesterday. And then from the peaks, if we catch the peak in here, we could be through it already. We might be dabbling at it. This, again, is a wonderful reminder of why traders would look for closing values to validate a breakout, right? As opposed to simply saying, all right, well, we're above it today. We can go, whole hog into any trades we want. I think that would be a very aggressive decision for even the most ardent bull here to take. So I don't necessarily think that that's what's going to happen, but we're looking to see, can we get a close over that downtrend line, and can it be aggressive? Can it make moves that would actually get through the last peaks in here? How about that for a significant development, everybody? If I took off the downtrend line and instead drew it from this spot horizontally, well, if we traded through here at 21,945, 950 or so, note what that would do for us. Yeah, it would mean a new short-term high, everybody. And what are we always looking for? Higher highs and higher lows. So if we just said that this is the level that we need to get through, some of you traders would start to get a little bit more potentially excitable on a move through 21,950. Obviously, again, closing values a bit more appropriate than others, but that would be a significant development. As good as it is today to get outside of that downtrend line, which I'll draw in one more time, and then I'm going to change the style of that line just so that it maybe it stands out a little bit. There we go. I'll change the style on this one too. So that's kind of what we're thinking about perhaps here at these elevated levels. What we don't want to see is how that candle looks right now. So if that candle today at the close looks like this, that would be less than excitable, right? If it is deeper, let's say that candle is working its way down into yesterday's candle, that's a even weaker development. We don't want to see that. So we would like to see some ability to basically maintain the low we've created today. If we zoomed in on a 5-minute bar, we'll just quickly point out the fact that we gapped up R1, essentially, everybody. Note how wide a level we're talking about. Here's our pivot at 21,640, and there's our upsloping 20-period exponential moving average. That's maybe giving us a potential for support. And notice how it coincides right now with yesterday's high trade. So just thinking about what we just saw on the daily and then bringing it into the 5-minute bars can give you a little bit of assistance. We would like to see support come into play immediately if we're going to get one of those exciting days where maybe we have only upside to contend with and only enthusiastic bullishness. But we really would need to see that start pretty quickly here. So maybe we check on that a little later in the morning. All right, let's look at our Russell. Our small caps continued to be mired under that 50-day moving average, everybody. We've been talking about the importance of it. Need to get through that ledge. And we see it right here. It's well defined because we've banged our head on that a number of times. We're getting a little bit of a bump today to the upside on our open, likely because we've noted rates coming back a little. Yesterday, we had the yield move to the upside, and today it's taken a little bit of a breather. Now, this is not reversing course, as you can see here. This is sitting on the 20-day moving average. Today's action fully engulfed by yesterday's action. We call that a harami. And that is, of course, now it's red, so a bearish harami. It's below the open today. But ultimately, it's more likely to stay within yesterday's candle than it is to break down. But if we did see yields back below the 50-day, that would be quite the development, everybody. We would like to see that from a standpoint of just what it could be doing to the small caps who are so interest rate sensitive, of course. So on the RUT, what are we looking for here, everybody? Well, we've talked a little bit about the consistency around the 200-day moving average. I'll just draw those in for you one more time. There's your one test right here. We have another test a little bit higher. That was, again, I call them tests, even though they didn't get to the 200-day. Notice the tail. The tail really tells us quite a bit. While this one got to the 200-day and with a tail, the tail itself tells us of a shift in sentiment, everybody. Remember what that implies. It was weak in the morning and bulls stepped in, and usually, or commonly in the midst of an uptrend, I should say, not usually, but commonly in the midst of an uptrend, if you find a higher low and you see a tail like this, if you can get a follow-through day, guys, I'm going to throw a test question at you all. You all are here frequently. You know what I'm talking about. A follow-through day after testing support, we commonly refer to those as CAHOLDs, right? A close above the high of the low day. That's your confirmatory action. So if this day is not a comfortable one to add, hopefully the second, maybe the third day after is when you get that close above the high of the low day, and that gives you the validation to step in. Look at it here. It was immediately the next day, gave you the validation to step in. Here it was day 2 right away, right? So maybe we are just in the midst of a little bit of sideways action in here. And I think that would not be the worst scenario to play out here. I'll draw a line consistent with these recent lows. So if you just kind of eyeball this area here, everybody, basically range bound over the last couple of months from 2,200 to 2,325 or so. Okay, so there we go, everyone. That's an approximation of the current short-term range. And really, the next directional move on the Russell will be determined by either trading above 2,325 on a close or below 2,200 on a close. I think those are fairly significant levels for the small cap and going to tell us quite a bit if and when one of those levels breaks. Okay. All right, what's going on in the chat? Good question, John. What exactly is the Russell composed of? So, you know, the easiest way to do this, honestly, is to utilize our visualize, the market watch, the heat map. There is your S&P 500. You're going to see a little bit more because obviously we got 4 times the stocks in the Russell 2000. So there you go, everybody. There is your allocation. So if we were going to talk about the components, the breakdown, if you will, you can see that the heavy weighting here in small caps is to financials. Financials has a very large allocation. You can see discretionary in there, of course. You got a few energy positions, but in terms of size of groups, financials makes up a substantial portion, as does tech, as does industrials and healthcare. So those are really your big four industry components, sector components rather, of the Russell 2000. That's a decent way to go about it. And by the way, I don't know if you all know this, but if you continue to open up the tree over here, and let's say you just wanted to see the groups within the stocks within the financials, let's just open up the financials and click financials. And now we're at the financial level. So we are looking at the sector of the financials collectively. If you want to break that out further, let's say you want to just see the insurers. Well, there you go. All right. What if you want to see just banks? There you are. Okay. So there's a lot of great opportunity here in the visualize breakdown as well that can kind of open your eyes to things. Those of you who attend the Friday session of Trader Talk, you all know that we speak on Friday about exchange traded funds. That's what we utilize. And there are ways that you can incorporate the Schwab.com website or sometimes even Thinkorswim to locate the top holdings in a given fund. And that can help you to understand maybe which are the leaders in a given space as well. But so can the visualize, the heat map here might offer some insights for you as well. By the way, there's been a recent enhancement to Thinkorswim that we're going to look at that is awesome. It's our ability to designate our lot assignments on sales. We're going to look at that here when we look at our example portfolio as well. I wanted to give you guys some heads up on some recent updates as well. So let's keep on moving through our review of the broad market. Let's peek in on our semis. Well, everybody, we haven't done anything yet, have we? Brent and I were just yesterday talking about the importance of getting through this bird's nest of moving averages right here, everybody. 20-day in orange, 50-day in purple, 200-day in blue. And we have pushed and rallied into that ledge 7-8 sessions, tried to get through it, can't get through it, continue to bang our head on the ceiling. When we do that, everybody, it's telling us something, right? We are not as strong as we would like to be. The fact that this continues to be resistance means that it allows short-term bears maybe to set their risk, because maybe a close above the three major moving averages for the first time in months would be, or at least in weeks, I should say, excuse me, would be a significant development, right? So right now, it still presents as though it could be a rejection. If you're bullish, many bulls are just sitting on their hands, everybody, because they've not gotten that close above the 20-day moving average or the 200 or essentially all three of them. And let's just revisit, why is it important to know that we have all those moving averages on top of each other? Well, the key takeaway for many traders when you see that is that traders in 3 different windows of time are evaluating the same level essentially as resistance. If you've got a short-term trader using a 20-day moving average, intermediate term using a 50, and long-term using a 200-day, and they are all seeing resistance at 5,100 approximately on the SOX, well, then that means you have the makeup for a significant move if it breaks one way, when it breaks one way or the other. We know it's going to break. We just don't know which way. So if we cleared the confluence of the moving averages and closed over, say 51 and a quarter, 51.50, something like that, then bulls are going to feel like we have the chance to fill that gap up to the red line potentially. And if we continue a rejection, maybe it's as simple as this very steep uptrend line. And if we get under this, maybe this is the kind of trades under this steep uptrend become trades where bears might feel a little bit more emboldened. Of course, a breakdown of that downtrend line could bring us to this matching set of lows, and moves under that is where things get decidedly more negative, unfortunately. So just some ways to think about what's going on in the SOX. Remember, just because nothing is going on right now doesn't mean that we shouldn't be thinking about what could be happening here, right? And if by thinking about it, we are prepared for the move when it comes, well, then we should be capable of making a decision on how we want to approach things from a standpoint of proper, right? A proper view, meaning not making a hasty decision in the moment, which is ultimately very, very important. Okay, so there we go, everybody. S&P 500, NASDAQ 100, Russell 2000, a look at the yields, a look at the semis. How about some sector action? Let's see what's moving here. We're going to work our way down the list. We'll start with energy, and we're just going to talk about it from a technical standpoint. I don't know that I'm going to have a whole lot of narrative detail to provide in a lot of these instances, but when I pull back on the on energy space, I can't help but just make note of the fact that for the last year or so, this ledge in the energy sector has been quite important. As you can see, we've been there once, twice, 3 times. So there's a strong zone of short-term support, everybody. So we got to monitor that potential to get there as we've kind of been bouncing around on energy. Not really trending right here, is it, everybody? Notice again, all those moving averages just working through things here. How about working our way down materials? I noted there's been a bounce in materials. We've got that down-sloping 50-day. Oddly, I say oddly because commonly a down-sloping moving average is a difficult place to establish support, and yet we bounced off of that ledge just yesterday. So perhaps materials are setting up. It does kind of look like a channel here for the short run. So improving in the sense that we've held this ledge now, dating back to, well, it's almost been 4 weeks. So that's not bad, right? But ultimately, traders are going to want to get out above that 565 level. There you go. Looking for a potential continuation of the recent new short-term trend. Sector list is available on Thinkorswim. There's a couple of ways of doing that, by the way. If you went in, I know I was showing you the visualize, but if we went to just quotes and you wanted to do it from here, you absolutely could. Don't forget, you go to right here for industry, and then you get the breakdown this way. Or if you wanted to go, so industry group, that is, sectors into all of the energy sector or just the sub-industry groups, you could get there that way. You can also come to the public list and select here, sector indices. And then that gives you these are the ones that I'm looking at right here, everybody. These are the exact same ones. So this is an easy way for you to take the list that I've got and build that into your own watch list as a reminder. So yeah, Isaiah, that's how you'd find it right here. It's also available as a watch list, so you can get the exact same thing via the watch list drop down right there. And if you want more, reminder, you can see the one with the ampersand and the industries there. That one will give you everything. So I'll show you that real quick too. So that is inclusive of your industry and sub-industry groups there as well, everybody. Okay. All right, back to our brief sector review. Let's work our way down industrials. Industrials had been in a nice uptrend. 50-day moving average was supportive until it wasn't. We are back above it and holding the 50 here again. We'd like to see that 50 flatten out, but it's an improving chart from a lot of traders' standpoints here, being that we're back up above the 50 and have been essentially outside of 2 days beneath it right here, basically above it since mid-January. So I think that's many would suggest an improving look here on the industrial sector. Consumer discretionary. This one bears watching. We talked about this earlier in the week with a look at discretionary breaking down on the heels of Tesla struggling. So discretionary is now looking at day 5, it looks like, beneath the 50-day moving average. Is that significant? Some would tell you that it is because day 5, notice we've not been below it for 5 consecutive sessions. Yeah, out here we were still kind of figuring things out when we were breaking our downtrend, and it took us a little bit. But since then, everybody, by the way, that was September 11 when we got it back above the 50-day moving average. We did not, until last week, have a close below the 50-day. So something is different as it relates to discretionary. What do we want to see? Speedy return back up above the 50-day. What we don't want to see is a rally into the 50-day that then loses steam and rolls over yet again. That would be the risk factor of a breakdown move like this. So any bounce that loses power at the 50, we got to be nervous about if you are watching discretionary. Some traders may have used the last week as a means of lightening up discretionary investment as a result of that, since it is absolutely a 5-day breakdown. So if you were using the Horner rule, you've exceeded 3 days below a major support zone. Some traders would use that as a reason to move on from portions of their trade, maybe build a little bit of cash, get a little bit more defensive. How about Staples? We are dabbling with a breakout. I'm going to have to put a chart on X about this one, everybody. Staples potentially ready to bust to the upside, and it could be notable. Here it is on the weekly, everyone. We'd had that standard throwback after a breakout. We talk about this one quite a bit, don't we? Breaking out to new highs, throwback to the breakout zone for support test, and then back to the upside. And that's exactly what we got here, everybody. Break, and it tried to get to continue that trend against that very quick 20-week moving average. It didn't, and we got thrown all the way back. Well, now we are right back at it. So bulls, if you've not participated in the last 5-week rally in Staples, now is not necessarily the time to do it, because we don't know that we're going to get a close over the highs, over 905, for example. So if you get it, great. Now you can start to build your risk tolerance to a tight level, right? Because a breakout may very well run longer than we expect. So that can allow you to set risk tightly rather than worrying about risk all the way down here. Because look, if you buy right now and we get rejected, you're not going to know that you were in the wrong officially on the trend of this until we take out the lows back here at 835. So that's a lot of risk, 65 points of risk on the $900 level at this moment. So that's one of the reasons traders might consider just being patient and allowing a breakout to occur here in Staples. First, healthcare improving. Nicely improving, did not hold the 200-day, but it did allow us the opportunity to get that 20-day moving average caught up. And now we might be setting up higher lows. So what's interesting about this, if nothing else, is if you're believing that healthcare is your opportunity right now, everybody, some short-term traders might position now. And then I'm going to lift that oval real briefly because I want to just highlight, look at this 4 days in a row. Look at these lows. Now, they're not identical, and they're not going to be, of course. Try not to be too fine in our evaluations of support, resistance, etc. Remember that they are commonly zones of support, zones of resistance. But we can take quite a bit of knowledge from just this action right in here, right? Tails that are bought up. So trade down, bought up. Trade down, bought up. Trade down to this level, bought up. Again, today traded to that level. All of that, coincident with an upsloping 20-day simple moving average, tells us that that could be support. Does it have to be? No, of course not. But it could be. And if it is support, well, then we shouldn't trade below the lows we've already made in the last 3 weeks at this level. So some traders could start to position here, right? Putting themselves on trades in healthcare, and then moving on if you make a new short-term low, because a new short-term low could bring us to the 50-day moving average. That might be more risk than some of you want to participate in. If you're thinking about this from an equity standpoint, of course, maybe you move into the visualize tab and you start playing with a few healthcare positions. And if you can find something that resembles a chart that you get from the underlying sector, that can give you some added confidence as well, everybody. Let's quick peek on financials. Financials have been doing quite well, largely due to the improving trend line we've seen on the 10 and 2 yield curve, which continues to move at least in an upward trajectory, similar to what we've seen since the summer here. And we've managed to make new short-term highs, managed to consolidate, allowing that 20-day to get caught up in here as well. Still a bullish trend looks like we're in a bit of a consolidation mode at this point. But really tough to argue with what you're getting out of financials here of late. We'll peek in on tech and then communications here momentarily. Boy, the tech one stands out, doesn't it, everybody? Look at that right there again, below the 50-day, kind of hitting our heads on that ceiling still. We need to get through the 50-day so that we can talk about gap fill pop potential into the lows that we had. So remember, this looks kind of like an island up here. And if we got to that spot, that would be notable. That could also be a zone or a level of potential resistance. But obviously, I think it's safe to say many traders would tell you, well, we can't get to this red line if we can't close over the 50-day. It is possible that's the kind of move we get someday where we maybe move through the 50 on an intraday basis and then just push into the red line throughout the entirety of a day. It's not a huge move, by the way. 46.20 is the 50-day here. And this level is 46.70. So it would only be a 50-point push in the sector, which would be something in the neighborhood of about 1%, of course. So that's a possible move, even in a very short-term basis. Communications, and then we'll wrap with utilities and real estate. Can't really give too much grief to communications here, can you, everybody? You had a wonderful little drawdown, and I do mean little. It brought you to the 50-day moving average. When it broke, traders who took that initial break as an opportunity, boy, did they like that trade, huh? Because it just kept moving from 350 all the way up to the highs at 378 or so. An excellent development. Now it's just pulled back to the 20-day moving average. I mean, pullbacks to the 20-day moving average, those are about as fun as you can find. If they hold for as long as they do, they can be fantastic. So that is a nice looking pullback to this point. New dollars might be deployed at this point, taking some of those off if you close below the 20-day. So as always, very different approach depending on whether you're starting a new position or working on an existing position. But as an example, if you're working on an existing position and you said, hey, the next time it closes below the 20-day, I'm just going to lighten up a little bit. Well, you'd have reason to do that. Because the down move would only be about 10 points. Not everybody would take such a move, to be quite honest, because you've got the 50-day providing support as well. So as always, know your time frame, know your comfort for risk, and give yourself some actionable steps to take when price action dictates it. Here's a quick look at utilities. We're up a little bit, pretty much flat, but we talked a little recently about the improvement in utilities. These are going to be all interest rate sensitive, as you know, everybody. Can real estate get to a new high here in the short run? That would be nice to see. We got to get over that 265, 266 on a closing basis. But notice once more, if I zoom in here on the real estate side of things, rising 20-day moving average, rising 200-day moving average, and then all of this action over the last 6 sessions here, everybody, 6-7 days, has held all that confluence. So now not only are we still above the 50, the 20, and the 200, we had a nice tail today, maybe looking to make a bounce there once more. So some really nicely developing sector charts here, everyone. Hope that sector review was helpful for you all. Let's talk about what I'm sure many of you are dying to get to, some stocks in the news this morning, many of which are moving quickly and speedily. So we're going to lead with one of the winners of yesterday's aftermarket. I was looking around for some updates on the ratings. I didn't see any earnings bumps, but we're going to look at AppLovin to get us started. App reported in the aftermarket and continues to do quite well. My goodness, that thing is over 500, traded as high today as 525. Wow, what a monster move. Today, Wedbush raised the firm's target on AppLovin up to 620 from 545, maintains an outperform rating on the shares following their Q4 report. Firm says that $30 billion in annual spending is growing by around 7% a year, shifting primarily from socials before 2020 to roughly 50% in mobile games today. So that's a newly developed marketplace, if you will, for AppLovin. And they are slowly gaining a huge share, according to Wedbush, of the $15 billion advertising spending inside of mobile gaming. So continues to think there's more upside as evidenced by that price target bump up to, what do we say, 620 from 545, maintaining an outperform rating. Piper Sandler also raised their price target on AppLovin to 575 from 400, maintaining an overweight rating on shares as well. Excellent development here. One other thing to bear in mind, this was a bit of a gamma move in this instance, because one of the things that I noted late yesterday was the extended nature of premium value. Stock finished yesterday at $380 a share. And I noted that the 550 call, 100 and my math, let me make sure I got that right, 170 points higher, a 45% premium, mind you, was still offering $1 a contract. That is a pretty ridiculous amount of premium. And that jump in price in after hours has forced the hand of market makers to be properly positioned to manage and get to neutral, right? Because the market maker's job is not to concern themselves with anything other than staying neutral and mitigating risk, of course. So that led to perhaps a portion of this move, but an excellent pop to the upside here in AppLovin. Now we can take a look at one that didn't go as well. Let's pull up Datadog here, and you can see that Datadog had a pretty negative reaction to the earnings report. They're off about 10%. We got beaten back pretty aggressively, trading under 130. And if I can find my note on that, I would be happy to share it. Evidently, I don't. I'm sorry, everybody. I don't have my note. But let's take a quick peek as to where it resides after breaking down in the trend. If I kick this back to my weekly chart, the thing that stands out to me is just all of this action and detail around these tails. So it could be said that, hey, we had this from this peak working through like this, might be an important area, happens to be coincident with that purple or pink 40-week moving average, as it were. So that could provide some semblance of support, but that's an ugly candle, needless to say. Many traders will allow this car in reverse to basically find a stopping point before trying to step into a position like this. That is a speedy reversal. Seeing some of you mentioned that this was up in pre-market. Well, it was at least doing better in pre-market until the early this morning here. So yeah, that did not bode well. My goodness, what an ugly bit of selling there. Okay, let's get to some alternates here that are moving around. Had one on. Oh, we had downgrades on the trade desk. TTD also did not have a good move, unfortunately. This one is ugly. So here we're off 31%, everybody. Evercore downgrading trade desk to inline. Previously, they'd been at outperform. New target is aggressively lower, unfortunately, down at 90 now from 135. The firm materially reduced estimates following the company's miss and their lower Q4 earnings results. It was the first time in 33 quarters that the trade desk had missed its guidance, according to analysts at Evercore. So they expect a fundamental correction for the shares, stating that the revenue growth has gone from premium to sub-premium for likely several fundamental reasons, and this has major valuation implications, they say. So heads up there, trade desk downgraded. Obviously, a downgrade would have been a better heads up for those holding the position yesterday, but my goodness, that is a rough thing to deal with, unfortunately, a real healthy move to the downside today. All right, everybody. And I realize here today that I didn't have, as much time as I thought I might have to get to everything I wanted to cover with you. So here's what we're going to do in our final 5 minutes. I'm going to bring in our example portfolio, and I wanted just to highlight the one recent shift to the Thinkorswim platform. And I'm going to just mention ways that you can all be notified of what's going on in your Thinkorswim. So if we go up to education and just click that button, then right here is release notes. So we made an update just last week on the 8th. And here tells you everything that was adjusted. So what is new? Well, there's a tax lot method selection. Great. That means that much like it used to be available, for those of you who are longtime Schwabies, for example, you may have been familiar with this availability in Street Smart Edge. This is now available here in Thinkorswim. And by the way, these are all active links. So, you can read the release notes, come to tax lot method selection, and it gives you the full breakdown of how to do it. But I'm going to walk you through it real quickly right now. So let's go to our monitor page. We've got a couple of positions working here from examples. One of them is JD.com. It's not working favorably, unfortunately. It's actually not working out well at all. Today having a pretty good, decent move lower. But if we wanted to sell some, and an easy way that some of you might do that is real quickly just right-clicking in there and say create closing order. So we have 285 shares. So we're going to just do sell, and down below I'm going to change my number of shares to fewer than 285. So let's just change that to 100. So I'm going to sell 100, but I want to designate the shares that I'm selling. So remember, let's briefly just point this out, that you have a defined process for your gain-loss scenario. If you've not made any alteration to it, it defaults to first in, first out. Now, you can alter that and tell us what you want your default to be, and we will take those instructions at schwab.com. But on a trade-to-trade basis, if you would like to designate something other than your default, you would do it right here via this gear icon. Clicking that gear, just like we do for conditions, it brings up the condition box, and now we have a method, a drop-down for tax lot method. Here you get to choose, do I want to do first in, first out, or my default, whatever my default is set to for that account? Do I want it to be last in, first out? Do I want it to be shares that are the highest cost or the lowest cost? Or maybe that is determined to be the best from a tax consequence standpoint. You get to designate that on each individual position. So here you might say, well, I'm going to sell the 100 LIFO, hit save, and then when you go through the process of selling it, the updated shares that are sold are the ones that were purchased most recently. That simple, okay? So I find this to be a wonderful addition to the wonderful enhancements to Thinkorswim here. And I wanted just to make sure that I pointed that out because it had been something that was kind of one of those gaps that we were working to fill here in Thinkorswim desktop. So just again, reminder, it's education and learning center. So if I just went back to the home of the learning center, you're just looking right here, release notes. Okay. So right along the top to release notes, and then release notes for the most recent. So this is the only one we've done this year. And then the other one, since I've got a little less than 2 minutes. I just wanted to point this one out too. Chart Navigator. That's a really cool one. Check this out, everybody. In your gear up above, if we went to our time axis, we could add this little scroll bar down below. And that little scroll bar will allow me the opportunity to play with this a little bit. So down here, notice, let me just let's try this, zoom this in. You can basically utilize your, I'm going to put in a new stock here. Let's put in, oh. And so it's supposed to, there it is. There we go. So see how I can move back in time? This is kind of a nice function. You know, you've been previously limited to utilizing your zoom functionality, right? Zoom, or if you have the trackball on your mouse, you can always control button and play with the trackball to increase or decrease your leveling or what have you. But you can also do it with that little chart. One more time, time axis chart navigator, showing the chart navigator. So that was a cool little adjustment as well. Just a couple of quick enhancements that might be utilized by some of you. And again, I'll remind you of what Thinkorswim really is. It is a living and breathing platform. It continues to get better and better. And part of that getting better and better is because of you, everybody. So, we are always listening to you. We're always taking your thoughts, your insights. The best way for you to share those with us is via the surveys you find in our segments. Looks like we didn't get a survey today, but nonetheless, another way is to engage with us on X. So please follow Barb and me on X, Kevin Horner, CS, Barb Armstrong, CS. If you like today's show, please hit that thumbs up button down below for us. We're going to get this one reviewed and into the archive for y'all as quickly as we can today. But that thumbs up button helps us a lot in the YouTube algorithm and getting this show out to as many viewers as possible. So with that, we'll wrap for the day. But thanks so much for being here. Be on the lookout for more from us. You can, of course, keep it tuned right here to the Schwab YouTube coaching channel. I look forward to seeing you all again real soon.